Welcome everybody. This is a very special roundtable today where we're going to be interviewing 4 leading industry experts in the field of multifamily properties. Today we have with us Morgan TURNBOW, Trent Pollard, Marianne Barnett, Tad Merrick, and Edward Gray. Can we start with Morgan and just have you introduce yourself and what you do?
Of course, great. Hi, I'm Morgan TURNBOW. I work for Colliers Valuation. I am based in New York and I am the Executive Managing Director. I oversee the Northeast region as well as national operations, and I look forward to chatting with you all today.
All right, Tad?
Hi, I'm Tad MARINAC. I am a principal at GTRE Commercial. We're a local firm here in Minneapolis made up of folks formerly from CBRE and Colliers and specialize as far as the multifamily product.
All right, Marianne?
Hi, I'm Marianne Barnett. I'm with BBG based in Dallas. I oversee the nationally our affordable and a lot of our multifamily practice. We have offices across the country, and I personally have been in multifamily for 30 years now. So happy to be here.
And Brooke.
It's Trent. I'm using my daughter's computer, so I apologize. Trent Pollard, TLP Realty Advisors. We're licensed in the state of California. I've been doing this since the late 90s, multifamily since the late 90s, appraisal since the early 90s, and we've got about 5 employees here, and primary areas are from San Luis Obispo down to San Diego, and again, specialize in multifamily, and I know a few of you up there, so I'm glad to work with, at least speak with you today. Okay,
great. And then the 2 moderators today are Edward Gray and myself. Edward, you want to introduce yourself?
Sure. So I'm Edward Gray. I'm a managing director at Greystone. I lend on real estate nationwide with a focus on apartment complexes for agency execution, Fannie Mae and Freddie Mac.
And
looking forward to today.
And my name is Daniel HOLMLUND. I am a partner at Aalon Capital. We focused on value-add multifamily deals in Texas and in the Sun Belt. All right, Edward, turn it over to you for the first question.
So I guess our first question for the panel is, the big one, we'll start with it, the state of the market. Where do you see it? Where are we going? Where are we? Marianne, do you want to kick off kind of talking about cap rates and what you're seeing?
Sure. Yeah, so we're, this obviously is top of mind for everybody. Really, everybody that I've talked to, it's expecting that cap rates are staying about the same. They're pretty much neutral at this point. Yes, interest rates have declined quite a bit, but the risk premium has just increased to keep cap rates about the same. We really haven't had a lot of transactions to be able to say they're moving one way or the other. And I'm speaking generally across all markets. Obviously, different ones have different little things going on. But for the most part, we haven't seen enough activity to really say, yes, they're going to go up. No, they're going to go down. For every person I hear one, I got another person who'll say the opposite. So.
Okay. Tad, you have any thoughts?
I guess as far as my thoughts, as far as our cap rates here in the Midwest, I'm looking at cap rates as far as they're starting to decline, actually. For a lot of the A product where we were seeing a 5 handle, now you're looking at deals that are really more in the 4s. A lot of that is driven by the 10-year Treasury note, which if you look at the yield rate on that, has taken a pretty stiff decline over the last year. So certainly tracking at less than 3/4 of a point. And as far as on DCRs, where we typically would see like maybe a 1.2 dropping down to 1.15 with amortization periods and LTVs staying the same.
Okay. Morgan?
Yeah, I think I agree. There aren't a lot of transactions or data points. So a lot of what we're doing is anecdotal. That being said, most of our conclusions across the board are either consistent with pre-COVID or most likely within a 25% basis point increase. That being said, I think it's important to note that all of the appraisers and market participants that I've spoken with recently, it's so nuanced that it's really market by market and asset by asset that, we're reflecting those kinds of cap rates.
Cool. Trent, what are you seeing?
Oh, I know we have a lot of directors and managers on it. I've got boots on the ground here, so unfortunately, I might be the lowest on the totem pole. But what I do see, I've had the fortunate, I've appraised properties pre-COVID and post-COVID, and so what we did for some major institutions, direct lenders, and those dropped generally between 1.7 and 9.7%. Again, it's not, as everybody put, it's not the derivation of the cap rate. There's no data to support higher or lower. However, it was rent driven. So we have some pretty good data from March 10th to post and post April, just basically rent trends. Values dropped in essence between 1 and 3%, but it's based on class B, C, A product type. So it's product specific, as Morgan mentioned. So that's what we're seeing. Not a whole lot of transactional volume though.
Okay. That kind of relates back to what Mary Ann said. The risk premium may be going up, value staying the same, but you're seeing some change in the rent collections.
Yeah, there's just so much uncertainty still. I mean, every month or every week, you know, we're all on these webinars and we're talking to people and everyone's like, oh, next week something's going to happen. Oh, next week something's going to happen. Oh, next week we're not going to collect rent. And then every time it's, okay, well, that was good. That was good. So I think the underpinnings of the economy before were so strong and we weren't out over our skis too much. We weren't just excessively lending crazy amounts on silly deals, that the market's still there. There's still so much demand. And that's a testament to you, Edward, and your group.
Thank you. Dan, you want to take over the next question?
Sure. And for the next question, we're going to dive a little bit more into the impact of COVID on the markets. Specifically, what have you seen in the area? We've mentioned lending a little bit here, and I'd love to get more comments on that. But on lending and on being able to have physical access to the properties, how have the ways of accessing the properties for due diligence specifically changed? And Morgan, we'll start with you.
Yeah, great, thanks. So initially, I think that we've started basically when we quote an appraisal assignment, we now also not only quote the scope of work, but the scope of inspection, which was something that didn't exist pre-COVID. And so as we've learned more, we found ourselves primarily inspecting vacant units at a property and all common areas, and then using what we're calling, again, another new term, supplemental interior pictures, whether it be taken by a property manager or the tenant themselves, and having that time stamped. So I think overall, we're still seeing interiors. I've heard of some cases where folks are also opening doors of occupied units to show that it's actually occupied, because there are, at times like these and of uncertainty, you know, I think there are increased concerns around risk and fraud and all of those things. So that being said, I think initially there was more of a knee-jerk reaction to avoid inspections altogether, but we've adjusted pretty well as an industry.
Do you see that being a problem going forward, or do you think we're going to have a gradual return to what it was pre-COVID?
I think it'll be a mix, honestly. I think there will be some folks who, you know, rightfully so, may say, I don't want strangers in my apartment, and that's okay. But I think it also goes to what, you know, on a much bigger level as a society, how we, you know, develop a vaccine and immunities and all of that. So I think it'll continue to evolve.
Okay. Mary Ann, what are you seeing?
Pretty much the same. I mean, we're working across the country also. So we're seeing everything from New York City, where things are still basically shut down and nobody wants, you know, you can't get around hardly, to the Midwest where everything's open. Some of them hardly ever shut down. We're also using, we still don't really want our people on planes. So in the case where we maybe have to go somewhere out, they're having to drive a lot more. If it's out in the country somewhere or out further away. We've also used some where we've teamed with a local appraiser that maybe is not our employee, who's willing to go do an inspection, get it approved by the agency beforehand and the lender, and then do those other steps like Morgan talked about, combining a personal inspection by that person that we know, virtual pictures, you know, and these are only in areas where we already have a comfort, where we know the market, where we've just done something, or especially on updates, we've done that. So.
Okay, Tad, what do you see?
Pretty much the same thing that the other two respondents meant. Is we're limited as far as what we can in the Minnesota Midwest area. We're starting to really come more out of it. We weren't as impacted by COVID. It doesn't change the fact, though, that we're limited as far as in the scope of our inspection. So obviously that has impacted us.
And lastly, our boots on the ground.
I concur with what they said. The only thing that's changed is I can conduct about 5 to 10 inspections in the time it took me to do 1 to 2 inspections before, because of lack of interior measurements and the focus on the interior. I think going forward, I think because we're such a litigious society, I think that there might be some video type of inspections that go through. I know that Freddie Mac has a virtual inspection. I went on one today where one of the inspectors from Greystone holds a camera, walks around, and then the people from Greystone can log in and then go on the tour. Is that correct, Ed? Are you involved in those?
I stay away far from as I can, but yeah, I believe that's exactly what we're doing.
Yeah. That's going forward. I think it will be less impacted from COVID. As everybody knows, it was a surface test before. Then it became, it's got to be masked. So before I was wearing gloves, long sleeve shirt, and then it would change after every inspection. And now it's just the mask and and washing and due diligence, and those things haven't changed.
Edward, over to you.
I had one quick question about COVID stuff. Tanner, what are you seeing as for thinking about home ownership impact on apartments versus home ownership? Is it going to have any change for us?
My opinion is I'm extremely bullish still on multifamily, and I look at the fundamentals as multifamily and single family housing run counter-cyclical to one another. I would foresee that multifamily will still stay very strong. I don't see there being a big flight as far as from COVID per se, as construction costs are clearly outpacing many markets in terms of rental rate growth, coupled with the additional increases as far as whether it be healthcare costs, student loan debt. A lot of those folks are probably not going to be migrating into single family housing. And that's certainly supported by the fact that there's not a whole lot of single family confidence as far as from a developer standpoint on that end. So it's my conclusion.
And I've heard that several people have made the claim that since there's a downturn in office space, in retail, in some sectors of the commercial housing sector, that there might be an influx of capital into the multifamily space. What do you think of that?
Yeah, I mean, where we're at, we've seen some conversion as far as from office into multifamily. As far as one of the bigger drivers really comes down to availability as far as labor, capital. I would see as far as in some markets that typically were especially weak with regards to office. St. Paul, Minnesota, for example, is a market in the office sector that has been historically fairly weak over the last couple of decades. Now you're seeing a greater propensity of some of those office buildings to essentially be removed off of the market and converted over to multifamily, and that will probably continue along that trend. And if you want to look at it from a historical standpoint, that's exactly what happened in Berlin, Germany, which is where they took a lot of industrial office buildings and they were converted over to multifamily housing. I expect that same kind of trend that's going to happen with regards to multifamily.
Okay. Hey, Morgan, you want to talk about any regional issues up in the Northeast, and we'll kind of work our way around the country?
Yeah, of course. So right now, again, I think regionally the Northeast was the hardest hit in terms of virus and just New York being entirely shut down. That being said, as far as multifamily go, I mean, Ted, I agree with you. I'm still pretty bullish on multi as well. Our folks in New York City are telling me that when they go, they're not adjusting cap rates right now. They initially, when this all started and we had less data around rent collections, we were underwriting, a 70% collection loss for some of these buildings. That's below the line, by the way. But we've now moved that down, and it's anywhere, depending on the asset, between 10 to 30% for 3 months. Our folks in New York did express out more so than the rest of the region, really, concern about what will happen in August, but more towards September as the CARES Act payments drop. They feel like folks may have enough revenue to cover an August rent, but then September may be when the rubber meets the road, so to speak, as far as longer term collection loss numbers. But overall, again, right now, to what I think Marianne mentioned earlier, like we keep holding our breath until new numbers come out, and you're like, oh, they're still okay. We're still at a 90+ collection loss on all the assets we look at, and that's across an A, B, or C product type. So again, I think there'll be some changes, but overall, regionally, I think multifamily will remain a coveted asset class.
Okay. Hey, Marianne, you want to talk about South Central, and don't hate on my oil markets too hard. We got to make a living down here.
Yeah, that's a whole nother topic. Yeah, I mean, I think, that the multifamily is going to stay. It's going to be strong. Back to the single family. I think that there might be some people that want to move to single family, but the end answer is they still can't qualify for the down. They still don't want to have the maintenance requirements. They, there's just, I think more the longer term recession in 2008 maybe taught some people that maybe you don't want to own an asset like that. You really want to be able to be mobile. I think one thing that's going to happen is the acceleration of some trends that were already in place where people are like, you know what, I want to live here. I'm going to go there and find a job. I want to move to Austin, Texas, because it's a cool town. I want to move to Nashville because it's a cool town, whatever, wherever it is. And then I'm going to find something there. I'm going to find my job. Or if work from home continues, you can work from home there. Doesn't matter. You got Wi-Fi, you can do it. So, I mean, I think for the South and the Sun Belt, those trends are going to continue. Some people are going to be, that might go, you know what? I had it for 4 months in New York. I don't want to be there anymore. I want to go somewhere else. I can still work from home. So, I think that's going to happen. Some of those trends will kind of accelerate that were already in the works. Yeah, I mean, Texas for sure has rebounded after every recession stronger than the prior situation before the downturn. I don't expect it'll be any different after this. Oil's coming back because we're all starting to drive again. As we start to drive, that's going to help also. And the good thing is not every market, there's a few that are very heavily dependent upon that. But for the most part, even Houston, Texas has such a huge port. Once we start buying stuff, the port's going to come back. Or it is already coming back. Chemicals, all of those things, that's going to drive demand that's going to permeate around the Southeast and the Southwest.
We like you saying nice things about Houston. Hey, Ted, you want to talk to us about North Central for a minute?
As far as what part of North Central?
Just the market. I mean, where do you, I know that you're personally in Minneapolis. Y'all currently have, a unique situation happening there, but, we were expecting growth through your territories. Are we expecting shrinkage? I mean, what are you seeing in your markets?
I think you're going to see continued growth as far as in the Midwest overall, Minnesota especially. Pretty strong dynamic workforce for one, well capitalized. It's not over levered as a general rule. That being said, I think products that you might find that are maybe on the upper top end or bottom end, those if they're going to run any kind of risk, you might see a little bit of a slowdown. And that's really a lot of it from governmental forces as far as in, say, for example, Minneapolis and St. Paul, a lot of affordable housing components being brought about for new development. That's certainly going to have a negative impact as far as on the economics of going forward on some of those deals. There's certainly proposals as far as with regards to limits on rental increases that's been proposed. Haven't been finalized. I would imagine they're probably strongly looking at the California statute that came across, I think it was 1482, that was passed with regards to tenant protections and limits on rent increases. I think the maximum is up to 10% depending on those. But as far as for what we're seeing in our product in the Midwest, I would consider it to be probably very, very strong. And we are certainly drawing a lot of outstate or out-of-state buyers. I think last year was like roughly 60% of all the transactions that occurred were from out of state as they're chasing after the yields that they're able to get, whether it be in Minnesota, Iowa, or some of those other locales.
Okay. Hey, Trent, when we switch to talking about the West, because you're up now, who are the buyers in California? I mean, are you moving to international buyers? Who are your people? Because we feel like the California buyers coming to see everybody else these days.
That would be depending on product type, right? And then by region. So if you're in closer to downtown LA, we have mostly global buyers versus mom and pops are buying more Class C, Class B product. So because of the stock market and the wealth that has created, the Class B market, used to be defined basically by product type, by value. It has now, because mom and pops have gotten so much cash that they're now investing in. So I would say regionally, locally, definitely people with experience. I would say that there is no detriment to the multifamily market in California from COVID. There has been a blip. It's impacted vacancy. It's impacted concessions. It's impacted rents slightly. But we're looking at typical holding periods of, say, 8 to 10 years, 8 to 12 years. So those little blips of, maybe increases of 5 to 15% are going to flatten out, if you will, flatten the curve over a longer term. So I think that the housing prices for single family are so high, and that multifamily did catch up for a while, especially in Class A plus locations like Santa Monica. However, the prices generally were parallel with the rental rates of the single family prices. So no detriment regarding single family on multifamily. And overall, to be honest with you, the multifamily was so strong here in California that this minor little blip that we've had may have been warranted, to be honest with you. It was almost a false high, if you will, because there was so much demand for housing. So overall, the buyers, it's been strong. There hasn't been a whole lot of transactional volume, like I mentioned. I did do a few Class A products, mixed-use products in Glendale and the greater Los Angeles area we used slower absorption rates, and we threw a couple bips on the cap rate based on our discussions in the market with brokers. But other than that, it's been pretty. Let's put it this way: it was hit hard at the beginning, and now it's starting to flatten out a little bit.
Okay. I think that's kind of the regional low take. Dana, you want to take the next question?
Yeah, we're going to piggyback off the theme of accelerating trends, particularly in regional areas. And so our next question focuses on, do you see any differences between the urban markets versus the suburban markets versus the tertiary markets that are moving further out? Do we see any, we've talked about the move, or at least there is a lot of talk about the move from potentially urban high density areas to lower density areas. Are there any other trends that you've seen accelerated either by COVID or just in general happening right now? And we'll start with Morgan.
Great. Yeah, I think there are a couple of trends that will accelerate based on COVID. I mean, the work from home is going to create a difference because you're going to see more and more people working from home. And so I think that it may increase demand for a little more space as people need to set up their home offices. Like, welcome to mine, there's a bike in the back, and but I think you might start to see rents of a studio maybe turning into a 1-bedroom, and a 1-bedroom maybe turning into a 2-bedroom, particularly for folks in urban markets. I was chatting with our apartment specialist in New York, and again, New York is resilient, but you do wonder what it will look like after this. We're seeing things go gangbusters in places like Westchester and just outside of the city. If people don't need to be commuting, and there is a huge concern around public transportation at this point, are they moving a little bit further out? Are they going to be in Jersey City? Are they going to be up in Connecticut? And so I think that we'll continue to see robust suburban markets that may have struggled if this had not come about.
Okay, over to Tad.
Yeah, I think there's going to be certainly some some increased migration out to the suburban markets. I agree with Morgan as far as people will be looking for perhaps greater space, which they can work from home. It certainly has put a bit of a scare into folks as far as regard their financial well-being as well, with folks getting laid off, the unemployment rate hitting a nominal rate of 15 and a real rate of north of 20%, that some folks on those Class A on that upper tail may be looking to scale down on a per square foot basis. So there might be some more migration for a larger space, and with similar amenities, just not as maybe new or nice of a product. The other thing that comes about is with regards to the current situation as far as a lot of national attention towards defunding police, I think is going to certainly perhaps push or accelerate for people to look at areas where maybe there's more security for them. So I think those areas are going to also probably benefit.
All right, MARINAC.
Yeah, I mean, I think, one thing that we might see in the Southeast and the Southwest is, we don't, good or bad, we don't use mass transit as much. So that's not as much of an issue here and across the Sun Belt. The urbanization, what is it called? Suburbanized urban. Urbanized suburban, that's what it is. Urbanized suburban locations where you can get still that feel of the downtown, but you're in a suburban location where it's denser. You get all of those activities. You get the recreation, the bars, the restaurants, all that. Because I think, people right now are saying they're going to move out. Some of that will happen. I think personally, I think some of that is a knee-jerk reaction right now. People are going, "Oh, I'm going to move out. I'm going to go out in the country." Reality sets in a couple years from now. That again, I'm very positive that we're going to find a vaccine. We're going to figure out how to all live together again. That you don't have to be separated in our houses like this. And so there'll be some of that back. And then this, younger generation, they maybe still haven't bought into this 100%. They're still out doing what they were doing. I know my kids are, or they want to. So, I think that's a trend that it was already happening, and I think it's going to continue, and it'll just be, we're not nearly as dense as New York, so I don't think I can really relate to what New York City is going through or has gone through or what the experience is and the repercussions. So, but, I think there's going to be, people want to have a little bit more space, but then the reality sets in that that's more expensive. So what do I do? How do I retool this? Maybe it's more economically designed space, which was already a trend. Accelerate that again. So.
And Trent, what's your take?
Well, I sure hope there's less cars on the road, and I sure hope there's more people that work from home, because we're in California and they love their cars here. So traffic is it's bumper to bumper, and it's been great over the past few months. There is a silver lining to COVID. All right, it's a horrible situation, but the traffic was eliminated, the skies are clear, and the smog is gone, and it's to be continued, I guess. We don't really know what's going to happen, but I do hope the trend is for more work at home. I do hope so, which would mean strength in SFR and single and multifamily.
Okay, Edward, over to you.
Had it on mute so you couldn't hear the baby and the dog in the back. I guess kind of the next question is, as we're starting to get close to wrapping up, long-term views. Where do we see this market going? I seem like everybody's pretty bullish on it. Tad, why don't you tell us what your long-term view on apartments and help us understand how you're coming with our values?
My long-term view of apartments is extremely strong, and I look at it from a very pragmatic standpoint. That with regards to, say, if you look at the drivers for it, employment is a great example. Folks do not have the same kind of tenure at an employer that they once had. And if anything, COVID even reinforced that more with the layoffs that people went through. They're much more fluid and dynamic in the places they want to live or where they want to work. So as far as multifamily, that certainly fits within their set. You touched on briefly as far as with regards to the 2008, Great Recession. These folks either experienced it firsthand or they watched their parents watch their equity strip away. So I think as far as the multifamily sector out there, I think, it's going to remain very strong. You're going to have more and more folks that are going to want to work from home, live in different locations, they will be enjoying different careers throughout their path as well.
Marianne, what do you see? What are your thoughts on the long-term view?
I mean, I think long-term, again, it's a very viable investment property type. It's going to come out of this quicker than many of the others. Two things I was going to comment on. I actually had a call this morning from a developer who was looking at an old Holiday Inn in Houston, a giant one that he's hoping to retool into multifamily. And that's been a discussion point. I think it's going to be hard because you're going back to some very small units, but when people want to convert a product type that isn't doing so well and maybe won't be doing so well into something that does, I mean, that's always helping the supply and not building extra. Let's reuse what we have. That's a good mentality if we can. I also, I think this is going to be advantageous for, and it's brought up even more about how we need more affordable housing. How do we do that? Not without maybe government intervention. I mean, the rent control, rent stabilization, I don't think that's the best way to go. Tax credits are a good methodology, but there's a lot of people that are lost in that workforce that don't meet those requirements. And so how do we build more without government intervention that is affordable for people? Whether it's value add, bringing the substandard projects or older projects up. I mean, I think that's going to be a long-term outcome that is really beneficial for the country as a whole. This has all brought that out. People need more security in their housing and not be overstretched in terms of how much they're paying. And, I think we need a variety of different types of housing like that fits that bill. I've also talked to people that are doing single family rental. So, I mean, all those different types go together to create the rental projects that we're all working on and that people are investing in because it appeals to the entire span of demographics that are out there.
How about you, Morgan? What's your take on the long-term apartment market?
Yeah, again, I think there's, we've seen post 2008-9, continued interest in real estate when a lot of that was driven by a collapse of real estate. So I think that there's plenty of capital. There's continued interest in investing in real estate. And when you look at the other asset classes, the reality is multifamily is your best bet long term. I think that we'll figure out, I think that's a great point, Marianne, about conversions. I think you might see an empty Sears or JCPenney actually converted into an office space, right? There are no elevators, it's flat, there's plenty of space, and it is cheap right now. But overall, retail is tricky, office is tricky, and so I think that in the landscape of everything, multifamily will continue to be strong. I think short term, we may see some impact I think, Tad, you had mentioned it, the Class A product, people might not be able to afford it. You might start to see that stabilized occupancy go from a 95 to a 90. And that may be for a couple of years, and you might see over time and with the unemployment, depending on how that rebounds, increased collection loss in the B, C, and C- product. But by and large, I think I am bullish on it, and I do think it remains a viable investment for the future.
How about you, Trent? What are you thinking for long-term apartments on the West Coast?
I speak with my wallet. I am invested in apartments, and I stand by them. I graduated in 1992 in one of the worst markets ever. Then we went through Northridge earthquake in 94. Then we had 2008. We had some other stuff going on between. I thought I had seen it all. Hadn't seen anything. If the market's recovered from those things, it's going to recover from this. All right. It's a blip on the screen, in my opinion, and people need a place to live. I agree with all the panelists. And Marianne, brilliant on the conversion. That's what we're seeing in downtown. We're seeing a lot of loft office building conversions that are converting to loft, and it's been a very successful trend. That if that Marianne though goes to retail, even more brilliant. So, but very bullish, and I agree with the panel.
Okay. Before I turn it over to Daniel, number one city on the West Coast, where are you investing your money? One city. Come on, Trent.
Oh, I thought you said Tad. Just Santa Monica. No brainer.
Santa Monica?
No brainer, yeah.
Tad, North Central, where are you going to go? One city.
That's a toss-up between Denver and Minneapolis, but you know what? I got to go with my home team, so I'm going to pick Minneapolis.
Minneapolis, all right. Marianne?
I gotta go Dallas, of course. I mean, Austin is right up there also, if they can figure out the traffic issues, and how hard it is to get entitled. But that's the thing about Dallas, it doesn't have those real issues.
Now, are you saying Dallas, the city, or DFW, the entity?
DFW, Dallas.
All of DFW?
I live
Morgan,
in-
how about you?
It's got some problems.
I think boroughs in New York City. They're high barriers there, but I still bet on the boroughs. I think New York is resilient.
Okay. Cool. Daniel, turning it over to you to.
All right, excellent. It's been great having all of our panelists on here. We've got views from New York, Los Angeles, Dallas, Fort Worth, Minneapolis, and this has been the state of the market in 2020. So thank you all for coming on, and I wish you all a good day.